Hi guys, Today's video here. In today's video, we want to look at the best way we can understand and trade liquidity. Now, liquidity is defined as any price area or a zone where you can actually imagine or see where retail traders will put their stop losses. Check in the upper right corner of this video to watch one of my videos on how to identify or spot liquidity in the forex market, and then the different types of liquidity that you can find on the forex market. You should watch that video first. It will give you an upper hand in understanding the concept that will be shared in today's video. Let's delve right into the video of the day. Now, there are two most basic concepts that you need to consider in trying to understand and trade liquidity the best way. Now, the number one rule or the concept is that price is always generating liquidity while targeting liquidity. So, for instance, before this bullish move could happen from this particular lower high into this particular higher high, we have price generated liquidity here to target the liquidity that was generated here. So rule number one, price is always generating liquidity while seeking liquidity. And then the second concept or the second rule is that price will always decide whether to continue in a direction or to reverse the direction after it has taken the last area of liquidity. Now, the last area of liquidity simply represents a liquidity price point or a liquidity area you've identified on a higher time frame. So monthly time frame, weekly time frame, and then the daily time frame. If you spot liquidity on any of these higher time frame, then it could serve as a last area of liquidity. For the purpose of the video, let us consider the daily time frame as our higher time frame and then try to identify the last area of liquidity. Let me do away with these drawings so that we can identify liquidity on the daily time frame. With reference from one of my videos that I asked you to watch before coming back to this particular video, this is how you can identify liquidity on the daily time frame. So if you see a doggy candle, it's liquidity. If you see a double bottom or triple bottom or double top or triple top, then it becomes an area of liquidity. So the arrow here indicates how price takes away the liquidity, and then the sign here indicates the liquidity point. Of course, you can see some of the arrow are very long, and then we have the short one. The short ones indicates an internal order flow liquidity, and then the long ones indicate the last area of liquidity. Let's delve right into the concept and then try to understand the story of liquidity. So right away, this liquidity point was generated by the bullish move and then the bearish move. So we identify this area as the last area. Of course, that is the ultimate time high before this bullish move happened. So right away from here, if I have my liquidity point, then with the story of liquidity, I expect price to tap into or take away the liquidity before any bearish move can continue. So we have price came back into this institutional zone or an order flow before price giving us the bullish move to target that liquidity. But then what did we see? When price came into this institutional zone, of course, price does not always move in one direction. We have this order flow generating this liquidity. But before price could target this top liquidity, it has to ensure that price is okay with liquidity. So price will always generate a minimum liquidity before moving to target a higher time frame liquidity. So we have price continuing the bearish move to target this liquidity. Now, after price have taken away the liquidity, look at what happened. It generated liquidity in the form of a doji candle before it continued the bullish move. So price is always generating liquidity while seeking liquidity. So this was the last area of liquidity. But you can see when price was coming down into this institutional zone, it generated internal liquidity. If you go down in time frame, for instance, the 4-hour time frame, you could see that there are a lot of liquidity zone within this area. But what did we see? Price disrespected those liquidity, and then the only time we saw when price gave us the actual move is when price have taken away this liquidity right point there. So price will always generate liquidity, move to the last area of liquidity, takes away that liquidity, and continue in the true move or in the true direction. And so the cycle continues. So right away from here, when price has taken this all-time high liquidity, the price needs to decide whether to continue in the direction or to reverse the direction. And of course, price was okay with taking liquidity. That was the last area of liquidity, of course. So price gave us this bearish movement and then try to target the liquidity that was generated as price goes up. So you see price targeted those liquidity, takes that liquidity, and from here we do expect that with the story of liquidity, price should take away this liquidity and continue the bullish move. But price did not do that. What did we see? Price suddenly reversed. Price was okay with liquidity here, and then it started moving up and up. Liquidity was generated here in the form of triple bottom, of course, which is liquidity, and then price continued. Now from here, this is where you could have identified that price was okay with liquidity. This bullish candle right here is an institutional candle. Now in my next video, I will show you how this candle is formed. Okay, it's an institutional candle, so price came back to retest it and then continue the bullish move, targeting this liquidity here that was created as price comes down. Okay, so but the last area of liquidity, which is this particular price point right there, price needs to target it before we can actually see any bearish or a true move. So price came into that top, takes away any potential sell orders that were here, and then after that it generated liquidity and then continued to give us the bearish drop. Now from here you could identify that if you go down into lower time frame, the 1 hour time frame for instance, you realize that this is a trend line. Okay, this will form a trend line right there, which will be a liquidity point. So price has to come in to take away that liquidity. Now when price did, generated liquidity in the form of a doji candle and then continue the bullish move. Price could not target this liquidity because liquidity was left here. It came down, takes away that liquidity. As it comes down, it generates liquidity right on top there and then there, of course. So this liquidity was a target point. When price has taken away this liquidity, you would know with experience and by the knowledge over here as an institutional candle has formed, you know that price was okay after taking this liquidity. So price could not come all the way down into this liquidity, which of course was very far away. So price has to make the retracement back to target this liquidity. And the cycle continued and continued and continued. Okay, so that is how price always reacts. Price is always targeting liquidity while seeking liquidity. Now in the 4 hour time frame, you could actually see a whole lot of internal or order flow liquidity that was disrespected as price fluctuates. So for instance, just by considering this all-time high, that is the last area of liquidity identified on the daily time frame, what we can see is that as price makes the bearish move, it continues to generate liquidity. For instance, here, there, and then here. Of course, you can see as price comes down, it generates liquidity to target the next point of liquidity. But what did we see? As price goes or continue in the bullish direction, we saw that price disrespected all those internal liquidity or the order flow liquidity. So what it's advisable to do is that you identify the last area of liquidity on a major or higher time frame. Now these are areas where price will actually respect or a true move will occur when these areas or liquidity points have been taken. So this particular point right there, and of course a last area of liquidity, we saw that price came into that particular price point, respected it nicely, and then the bullish move continued. So you see, as price comes down, it generated liquidity there. But when price reversed in the true direction, these internal liquidities were not respected. It doesn't actually mean that these internal or other flow liquidity zones will always be disrespected. For instance, we know price was in a bullish run to target this all-time high or the last area of liquidity, as we did so in the daily time frame. And then as price goes up, it generated this liquidity point right there, which is an internal liquidity. Now it took away that liquidity there and then tried to give an opportunity for the bears to come into the market. What did we see? As price makes its way down, the only time we saw a retracement was when this internal liquidity has been taken. So internal liquidity taken right away from there. You could look for your trade setup after the liquidity has been taken. Then we have this short bullish run. Now this is something right here. This is a fair value gap and this is an indecision candle and its top is liquidity. What did we see? After price gave us this short bullish run, in order to continue the bearish move, it tapped into the fair value gap, takes away that liquidity, which is an internal liquidity, and then the bearish move continued. That is the story of liquidity. So you see, if you combine it with fair value gap and then liquidity, you have a better chance at the market than just looking at maybe trend line alone or smart money concept or whatever concept that you are using. I'm not saying your concept is wrong, but trading in the forex market has to do with probabilities. So what is the probability that the market will be bullish to the probability that the market will be bearish? And then in that case, combining 2 or 3 concepts like liquidity, fair value gap, supply and demand gives you a better chance than trading one concept alone. All right. So yeah, that is it about the story of liquidity. You can see price will always generate liquidity while seeking liquidity. And then of course, price will always make the true run or the true move after it has taken away the last area of liquidity. That is it for this particular video. Do the YouTube draw, subscribe to my YouTube channel, hit the notification button, like the video, comment and share. Thank you for doing that. See you in the next video. Peace out.